Now, Goldman Sachs was hardly the only bad actor in bringing our financial system to the brink of collapse in 2008. Traders and executives at many other financial institutions got fabulously wealthy by gaming the unregulated casinos on Wall Street. They walked away with fortunes, even as millions of Americans lost their jobs, their savings, and their homes. Yet, as we witnessed in yesterday's hearing, Wall Street remains quite arrogant and quite unrepentant and quite unwilling to change its ways. It has the gall to believe that it should remain free to do business as usual. To that end, I am told it has mobilized a legion of lobbyists, an estimated 1,500 of them, 15 lobbyists for every senator, to try to kill or water down, stop this financial regulation reform from coming to the floor. It's deeply unfortunate that every one of our colleagues on the other side of the aisle, every single Republican, has joined with Wall Street in obstructing this legislation. Every single Republican, not just filibustering the bill, but preventing it from even coming to the floor for debate, an amendment. Now, they keep saying they want to improve the bill. Well, is that not what the debate and amendment process is about? If someone has a better idea, offer it as an amendment. Let's debate it. Maybe it is better. Maybe we'll adopt it. Maybe we won't. But it seems to me that's the way we ought to be conducting the nation's business here on the Senate floor. So I say to my Republican colleagues, Senator Dodd and Senator Lincoln have bent over backward to consult with them and invite bipartisan cooperation. Their good faith efforts have produced solid, common sense legislation. Well, but if people on the other side of the aisle want some changes, that's what the amendment process is for. We're not cutting off anyone. We want to bring the bill up. It's open for amendment. Why are the Republicans so afraid of offering amendments on the floor if they've got a better idea on how we should do this? It's a bitter irony, Mr. President, that even as we've spent a fortune in taxpayer dollars to rescue the global financial system, the self-appointed masters of the universe on Wall Street rewarded themselves with billions in bonuses, and they've geared up to fight the efforts here to prevent this from happening again. Well, it seems that Wall Street is all too used to living a different life, playing by different rules than the rest of the country. Nowhere is this disconnect between Wall Street and Main Street more stark than in the area of compensation. Over the last decades, compensation in the financial sector has skyrocketed, with some executives walking away with annual compensations hundreds of millions of dollars, even as the inflation-adjusted incomes of ordinary working Americans have remained static. Mr. President, this chart traces the financial industry profits as a share of domestic profits since 1948. From 1948 to about 1980, you can see it remain fairly stable, little bumps up, little things down, little bumps up, but basically stayed pretty even, somewhere between 8% and 18%. So somewhere between 8 and 18% of all domestic profits in this country. Think about everything in this country, all the profits made. About 8 to 18% was taken by the financial sector and Wall Street. But starting in 1984, financial profits began to rise dramatically. You can just see it here, going way up. In 2001, financial industry profits were almost 45% of all domestic profits in America. Almost half, 45%, up from about 8 to 18%. And today, despite the 2008 meltdown, they're back above 35%. 35% of all of the profits made in America going to Wall Street, going to the financial sector. Now, Mr. President, this is a concentration of wealth unprecedented in our history, even worse than before 1929. worse than before 1929. Now, the second chart here contrasts this explosion of wealth on Wall Street to what happened to ordinary Americans on Main Street. From 1990, which we have right in here, well, I can't read it myself here, 1990 to 2008, real median household income stagnated at about $50,000, right in here, just stagnated. Since 2000, real median household incomes have actually fallen. So from about 1990 to today, real median household incomes stagnated and actually fallen from where they were here. We had a steady increase over the years. From 1990, stagnated, now it's fallen down. That's what's happening to the average household in America, the median household in America. Well, let's see what was happening to our friends on Wall Street then. Well, let's see what happened on Wall Street. Well, just as we were stagnating in median household income from about 1990 on, look what's happened to the average Wall Street bonus. Huge. Wall Street compensation skyrocketed nearly 300% during this period of time. Since 1990, the average Wall Street bonus, now I'm not even talking about salaries, I'm just talking about bonuses, soared from just under $50,000 in the early 1990s to more than $200,000 in 2006. Now, go out and talk to our constituents. Go out and talk to the Main Street business people that run our shops, and talk to anybody out in America today. Did their income increase 300% during that period of time? No, it's state level. But look at the bonuses. And that's just the bonuses. I'm not talking even about their salaries. This is bonuses. Well, I dwell on this, and I point this out, Mr. President, because I think it points to a larger issue. In my view, a big reason for the financial collapse of 2008 is that things got out of balance and they got out of whack. As Glass-Steagall was repealed, and I might say this forthrightly, there were 8 senators on this floor that voted against the repeal of Glass-Steagall. And I'm proud to say I was one of them. But I remember at that time saying, wait a minute, there is a reason why in the 1930s under President Roosevelt that we didn't want to have this happening again. So we said to commercial banks, if you want to be a bank and take bank deposits, fine, you can be a bank. But you can't do insurance, and you can't do investments. You can't do swaps and derivatives and all that kind of stuff. You're a commercial bank. And for that, we give you FDIC protection. We also give you Federal Reserve protection. We said to insurance companies, you want to be insurance companies, fine, but you can't be a bank. We said to investment houses, if you want to take money in to invest, fine, that's your deal. But you can't take deposits. You're not a depository bank. And you don't get the protections of FDIC and other things, Federal Reserve. Well, in 1999, this Congress repealed that. Put them all together. I said at the time, and the record will show I said, I hope it doesn't happen. I hope all these smart people know what they're doing, but I don't trust it. I don't trust it. Because you're going to start having a lot of funny games playing. In the last 10 years, we saw the games they played. Well, the special interests, after Glass-Steagall was repealed, they attacked the very idea of government regulation. The SEC, other watchdog agencies just started doing nothing. Wall Street stepped into the void. Now they had all the protections that we, consumers and others had under Glass-Steagall was gone. And so what they did, they just drove our economy off a cliff. And ordinary, hard-working Americans had to pick up the tab. And that's why we need this serious financial reform. As others have noted, and I say again, financial crises in this country shouldn't be looked upon as floods that just come every 10 years. or some kind of natural disaster that you sort of accept, that every so often we're going to have a flood, or we're going to have a hurricane hit the coast, or we're going to have a drought someplace. Financial collapses that has happened in the past, these are not preordained kind of happenings to our system. They happen because we let people run amok with large sums of money, gamble it. Some get fabulously rich. Some get fabulously rich. But then they just drive the economy off a cliff. So again, so what we do to protect ourselves against floods, what do? Well, we do a lot of upland treatment. We build dams. We build levees. We do all kinds of things to protect ourselves from these. Well, there's things we can do to protect ourselves from financial collapse, too. It's just putting into place the kinds of oversight and transparency and regulations that allow our capitalist system to operate, but to operate within some bounds. To operate within some bounds. I don't think anyone is in favor of what we might call unbridled capitalism, the kind that we had in the 19th century, early part of the 20th century. I don't think anybody wants to go back to those days. Yes, we believe in a capitalist system where people can take their savings and invest it, make their money work for them, loan it out to other people so other people can start businesses. That's the capitalist model. Nothing wrong with that. But should we let people take our money that we have saved up for pensions, for example, or other kinds of investments, and take those and sort of go to Las Vegas? I don't think so. We want some rules and regulations so they can make prudent investments, so those investments can be used to start businesses, to invest in economic growth on a broad basis, but not to be used for speculation, not to be used for just gross speculation on Wall Street. And so that's why we need this financial reform bill that we have, that we're trying to get up here on the floor. It will guard against future massive meltdowns that always cost us not only so much money, but just in ruined lives. Ruined lives. And by all means, the strong financial reform must include regulations of the derivatives market. This is something, Mr. President, I have been involved in for a long time on the Agriculture Committee, for all the years I have served there with the Commodity Futures Trading Commission, and looking at what's happening in the derivatives markets. And I'm pleased to say that the legislation that we're trying to bring up here includes the provisions that passed out of the Agriculture Committee under the leadership of our chairman, Senator Lincoln. Derivatives contracts have been at the heart of the Wall Street's financial manipulation. From December of 2000 to June of 2008, the height of the Wall Street boom, the face value, they say that notional value, face value of over-the-counter derivatives grew from $95 billion in 2000 to $683 trillion in 2008. And there was really nothing underlying this, other than people just shifting things back and forth and betting on them back and forth. But there was nothing underlying this. Now, I want to make it clear. People say, are you against all derivatives? I say, no. There are basic derivatives that can be healthy for our economy and for individuals, from businesses to farms to individuals. I always point out a classic derivative is like when an individual buys a home. They buy their home, they buy a new house, it's their home, they put their money down, they got a big mortgage, you're going to pay it off. And a lot of times people will get a little insurance. It's called homeowners insurance, that if you die, your mortgage will be paid for. A lot of us, I remember when we bought our house, we bought that kind of insurance. That's a derivative. Nothing wrong with that. I buy some insurance to protect my family. Farmers use derivatives. Businesses use them to protect against currency fluctuations, things like that. That's fine. These are basic derivatives. Well, Mr. President, since I see no one else on the floor, I ask for another 7 minutes.
Without objection, so ordered.
Thank you. So, like I said, I have no objection to the basic derivatives. It's when these derivatives get out of hands. It's when you have a derivative on a derivative on a derivative on a derivative and on and on and on. And that's what's happening to the derivatives markets. And these become just little gambling things. There's instances of derivatives passing back and forth between speculators 2 or 3 or 4 times a day on small margins, small tenth of a cent, maybe 100th of a cent margins, but on big pools of money, big pools, pure speculation. Well, so despite the usefulness of derivatives, in certain cases, it got out of hand. So what we reported out of the Agriculture Committee would, number one, bring all these transactions to the light of day, no more behind the scenes. They'd have to be reported to regulators in real time. It would bring the vast majority, 90% or more of these, onto clearinghouses and exchanges. It would help to reduce the concentration of risk, bolster public transparency, and the legislation that we're trying to bring up here that the Republicans keep blocking gets to the heart of too big to fail problem by prohibiting these swaps entities, these derivative entities, from also being commercial banks. We kind of go back to Glass-Steagall. We say a commercial bank backed by the government or FDIC should not be able to use that government backing to support these high-stakes gambling. If you want to be a commercial bank, God bless you, be a commercial bank. But you can't be dealing in these swaps and derivatives. Let the investment houses take care of that. It's unfair to taxpayers and to our economy to let our banks do that. It's unfair to community banks. I just met in my office yesterday with all our community banks, well, not all, but most of the community banks in Iowa. They don't deal in swaps and derivatives. They take deposits, they loan them out for business starts and people that need a loan for different things. They're not dealing in swaps and derivatives. So why should we allow these big banks on Wall Street to do it themselves? No reason for that other than they just want to do it and again, to continue this kind of rampant speculation. Also in this bill, we put in an independent financial consumer protection agency to guard against rip-offs and abuses in mortgages, credit cards, payday loans, and other financial products. To protect consumers. Sorely needed. We slammed the door on too big to fail financial institutions. No more AIGs, no more Citicorps. When companies make huge bets and lose, there ought to be a process for liquidating those companies. Period. Not that there's too big and we got to rush in with taxpayers' help. Now, to further improve the bill, I am co-sponsor of legislation offered by Senator Cantwell that would recreate the Great Depression-era regulation that prohibited the mixing of banks, investment banks, and insurance companies. It's almost like the reinstatement of the Glass-Steagall, and we ought to do it. Senator Cantwell has been leading that, and I thank her for that. I'm also a co-sponsor of the Safe Banking Act offered by Senators Brown and Kaufman that would limit the size of the largest institutions. No more too big to fail. In addition, I support legislation by Senators Merkley and Levin that blocks institutions that are insured by the FDIC from proprietary trading with their own money, their own funds. We just can't have these big banks playing with their money if it's backed by the taxpayers of this country. So again, Mr. President, America's been through financial collapses and deep economic downturns before, but we learned in the Great Depression. We learned. FDR answered that crisis by implementing tough new regulations to stabilize the financial system, rein in risk-taking and recklessness on Wall Street, make the economy work for ordinary Americans. Because of those reforms made in the 1930s, we had decades of shared economic prosperity unprecedented in our nation's history. And then we threw it all overboard about 10 years ago, 11 years ago. Well, what we did in the 30s needs to be our model. Not exactly the same, we have a different system. But it needs to be our model as we shape today's financial reform legislation. Financial reform legislation, ought to separate these big entities out. We can't have too big to fail. We need to have transparency. We need to stop banks from engaging in swaps and derivatives back and forth if they're backed by the FDIC. Now, these amendments, the Cantwell Amendment, the Merkley Amendment, and others that I happen to be supporting, again, we can't offer it unless we get the bill to the floor. Now, I don't know if we'll win or not on those, but we ought to have the right to offer those amendments. And I tell you, I just want to thank Senator Dodd. He has been in the forefront of this fight for a long time, trying to bring this bill to the floor, to crack down on all of this speculation, to put regulation in there, to have a good consumer protection agency out there to protect our consumers. Senator Dodd has led this effort. And I know where his heart is. I know how he's trying to make sure that this system works for everybody, not just Wall Street. And I don't know, I don't want to be in the role of bashing Wall Street all the time. I know that's a popular sport. Wall Street has a role to play in our society. They sure do. They are a fountain of investments on a large scale. I have no problem with that. My only problem is with some of the dealings they've been doing with the swaps and derivatives and things like that. But let's get Wall Street back to what Wall Street does the best: accumulating capital, investing that capital in the economic growth of America. That's what the Dodd bill does. Gets us back to that system, straightens things out, and helps us to protect us from these kind of collapses in the future. I do not understand why the Republicans will not let this bill come to the floor, won't even let it come to the floor. Now, I don't mind if they want to vote against it. If they want to be on the side of keeping Wall Street speculating with taxpayers' dollars and letting these things get too big to fail, that's their right. But why not let the bill come to the floor so we can debate it and amend it? If they want to change it, let them offer amendments. But you can't do that unless we bring the bill to the floor. I hope the American people understand this. I hope they understand that that side of the aisle, the Republicans, will not let this bill even come to the floor for debate and vote. I say to my friend and my colleague, Senator Dodd.
The senator has used his 7 minutes.
I ask one more minute.
Without objection, so ordered.
I say to my friend, Senator Dodd, I thank you for all the hard work you've put into this, you and your staff, your committee. This is a good bill. And again, we may not agree on every little jot and tittle of it. There's some things I'd like to offer an amendment on. Maybe it'll win, maybe it won't. But this is a good bill. It's a solid bill, and it will help us get control back again over Wall Street and all the wild speculation, and it will help our country grow as it should, not in one small area, but broadly based economic growth in our country. So I thank Senator Dodd for his great leadership on this, and I just hope my Republican friends will understand that we have to get this bill up on the floor, and we have to protect the American people from these financial collapses like they've happened just in the last couple of years. Mr. President, with that, I yield the floor.